There's been a lot of talk among the politicos and the economists that Australia has avoided the worst of the recession, but it seems that NAB didn't get the memo. Somebody left them off the CC line. Heidi, apparently, NAB dropped a bad debt bombshell on the markets today, and they're going, please give us billions of dollars.
That's it in a nutshell, Bernie. I think everything was going on swimmingly. A couple of analysts, they even raised their rating on the NAB shares in the past couple of weeks, but then there was a giant skeleton lurking in the closet, and today it's been let out. There's a lot of analysts which have been left scratching their heads saying they didn't see this one coming. The NAB has announced a $1 billion charge for bad debts. It's expecting that rising unemployment will cause more debt defaults, and that's going to mean cash earnings in Q3 are likely to come in at just under $1 billion Australian dollars. The NAB is heading to the equity markets to shore up its balance sheet to cover those bad debts, and it's selling a little over $2 billion worth of new shares in a mega capital raising. Analysts that we've spoken to today have been really shocked by the $2 billion capital raising. They thought that when the bank raised just under $3 billion last November, that would be enough to see the bank through the credit cycle. Not so. Others are worried about the impact on earnings per share. Of course, if the bank floods the market with more shares, it'll dilute the earnings per share for investors. Bernie?
Okay, that's a lot of cash called there. And we talked a while ago, a few weeks ago, about last in, first out, how Australia really managed to sort of skim the surface of recession and extricate itself. Is that more is the wisdom more toward the optimism or toward the I don't know? This is going to go on for some time. What's the sort of mental state going on?
Well, I mean, if you look at the Reserve Bank minutes yesterday, they're quite upbeat, and it looks like Glenn Stevens had some quite upbeat forecasts on the economy, and they were predicting growth before the end of the year. But then, of course, we've had this NAB bombshell, and as I said, no one was really expecting this, and no one saw this coming. And now, if you look at a lot of the other banking stocks today, they're down as well. So some of the sentiment in the market is, wow, if this is happening to the NAB, what else is out there? Are there more bad debts that we haven't yet seen? And are we perhaps, as an economy, not doing as well as everyone expected? Bernie?
Yeah, well, that's kind of a crouching position to be asking for a big cash call. Here's a slightly different story, Heidi and folks. Chinese cement maker BBMG's IPO looking like it's going to be Hong Kong's hottest share sale in more than a year and a half or so. The Post reporting this morning that it's drawn almost $40 billion over 3 days. Retail portion of the offer will be at least 650 times subscribed by the time it closes today, and also triggering a clawback provision as well. Some of the stock, some of the equity that was set aside for institutions will probably be rolled back into the retail space. And we're talking about a $5 billion issue here. So, geez, $650 billion chasing $5 billion. What a wacky world. Jeff Lewis, once again, birthday boy from JPM Asset Management, rejoins us on the program today. You know, when you get at something like National Australia Bank, saying, ooh, we need a provision because we see a pretty depressing environment coming. What does that tell you? And this is a country that's really removed from a lot of the problems that we've been talking about.
Well, first of all, it illustrates how the banking problems spread from the U.S. from subprime and really infected institutions right around the globe, driven by excess liquidity. It also tells you that bank recapitalization is a work in progress, and I think there'll be a few more surprises. But some will surprise on the upside, I think. It's not all going to be bad news. I mean, banks are going to be the high beta investment for the really brave.
But that kind of flies in the face of a lot of other opinion, which says that financials are where you want to be. Let's say in the China context, or even in the India context, because after the mess is cleared, if the smoke is cleared, risk management is a heck of a lot healthier than it was a couple of years ago, and people aren't really wild west cowboys when it comes to OPM. Other people's money, and it may not be as high beta as you were talking about. I mean, where do the financials lie in the pecking order, in your view?
Oh yeah, well, I would distinguish very much between Asian banks and financials, where we are overweight both India and China, because they were never as heavily leveraged. They've got much sounder balance sheets. They don't have the structural problems that banks in, say, Europe or the US do. So they are a much safer bet, if you like. So we favour the banks regionally, but I think there could be some good recovery stories, perhaps, amongst banks elsewhere, although there are pitfalls as NAB has so rightly warned us.
Okay. Jeff, I'm going to bring normally I wait a little bit to collate and collect some of the emails, and then we kind of do it in one go in the second half of the show. But some of these are quite relevant to what we're talking about right now. So I'd like to bring up one from Nick, who writes as the case where, coincidentally, from Australia. And Nick writes, the huge growth we've seen in the past decades has been driven by excess debt from consumer to companies. We've been living beyond our means. We know that. Is this now a thing of the past? If this is not going to continue in the future, what would be the catalyst for economic expansion if we're going to that new where we're self-imposing austerity for some time? Want to take this one up before we take another break?
Okay, that's a very interesting question. It's quite a difficult one. Obviously, the super debt cycle is over, and U.S. households are deleveraging. But they've already made quite a bit of progress. The savings ratio is now 8%. Take that forward for 3 years, and you're going to have an extra net savings of $2.5 trillion, which could go quite a way to accomplishing the deleveraging of the household sector. Well, I think it's wrong to look for some major factor. There's always economic growth, and the sources of growth are really diversified. The U.S. economy, for example, is growing by 1.5% due to the net exports because the dollar is cheap. There are always sources of growth.
So steady as she goes may not be a bad thing. We don't need these big, illumination bombs or anything to keep life interesting.
We need them like a coal in the head.
Yeah, we need them like a hole in the head. You know what a hole in the head will do to you.